hands you their financial statement. Revenue is up, numbers look healthy, profit is amazing, almost everything is perfect. But how do you know if all of this is true? How do you know if the sale is real? If the asset actually exists? Welcome to CAM, Concept in a Minute, your one stop for business and finance terms explained simply. And today we are talking about substantive procedures. Substantive procedures are how the auditors test the accuracy of the numbers in financial statements. Think about it. People make major business decisions based on the numbers in financial statements. Investors decide whether to invest in them using these numbers. Banks decide whether or not to give loans. Tax authorities understand what money is owed to them. So, if these numbers are not accurate, people will end up losing their money. Fraud may go undetected. And that is why auditors test these numbers. And that exactly is why substantive procedures exist. So, there are two main types of substantive procedures. Type 1 is test of details. That is the most direct approach. Specific transactions are compared against the real evidences. So imagine, for example, that a company claims that they have 80 lakh rupees in receivables. That is the money that the customer owes to them. So here, the auditors send letters of confirmation directly to the customers, not through the company, independently from the auditor. And the customers confirm what value of money they owe to the company directly to the auditor. That's clean. That's independent proof. Type 2, analytical procedure. Now, analytical procedures have a completely different approach. It forces the auditor to step back, look at the big picture, and spot any unusual patterns. For example, imagine that the company had around 35% of gross profit consistently for the previous 4 years. But this year, their gross profit fell down to 18%. That's unusual. That requires investigating. Why did the gross profit actually fall down that quickly and that much in just 1 year? Another example, revenue jumps 60% in December. Is that expected or is that manipulated? Analytical procedures helps to identify red flags, and when something looks off, it becomes a starting point for deeper testing for the auditors. If you are preparing for ACCA's audit and assurance paper, substantive procedures are guaranteed to be heavily tested. The examiner loves scenario-based questions. They will explain a situation and then they will ask, what substantive procedures will you perform here? Here's the key to scoring well. Be specific, be practical, and link it to audit risks and assertion. Don't just say check the invoices. Instead say obtain a copy of the invoices and agree to the corresponding goods dispatch note, customer orders, and bank receipts. This helps to ensure that the transaction is real, accurate, and recorded in the correct accounting period. That's the level of examiner accuracy that they expect from ACCA students. And that is what you require to score a good mark in AA. Another tip is you can try explaining why you are performing that procedure. What are you actually testing for? What could go wrong here? For example, testing the year-end journal entries for any unusual transactions or related party transactions because these are areas for high risk of manipulation. Here's something important. Auditors don't apply every single procedure everywhere equally. They use their professional judgment along with risk assessment procedures. High risk transactions such as revenue recognition, large balances, etc. get heavy test of details, whereas low risk areas like routine operating expenses may be only handled with analytical procedures alone. Auditors primarily use substantive procedures to collect this level of evidence. Substantive procedures separate real audit from simply reading numbers from a paper. They are proof and they are evidence. And that's how auditors know how the numbers are accurate or not. Studying for AA this session? Click on that subscribe button to have more